I was in CNBC Asia last week, and it's even messier there, I think, to actually get behind the paywall. I couldn't see what I said. And I'm definitely not paying to get behind that paywall because Okay, folks, it is 12:30, so I am going to get started. A couple of things. One is, if you had a chance to run the optimal capital structure, it's good to be caught up. And as I said, one of the nice things about that spreadsheet will get you caught up on pretty much everything else you were supposed to have done already, right? Compute the market value of debt, convert leases to debt, come up with the existing cost of capital. So remember, when you do that optimal debt ratio, remember not to double count leases. And this, especially in a year like this one, it can easily happen. And here's why. The spreadsheet allows you to capitalize leases by including lease commitments, entering the lease commitments, and then I do the present value. Nothing magical. But for many of your companies that are following IFRS or GAAP, those leases are already treated as debt. So from that perspective, if you include the debt that's on the balance sheet and it already includes leases, and you ask me to capitalize debt, you'll be double counting the leases. So make sure that's not happening, because if it's happening, it's going to kind of make your debt look bigger than it should be. Any questions on that spreadsheet before we get started? Now, before I get started, one thing though, my broadband, I use Spectrum, local cable provider for my broadband, and I've been having real issues for the last couple of weeks. So if at any point in time my slides get frozen or you notice something weird happening with the audio, let me know. I'll turn off my video and then we'll move on. So last session, we were talking about the enhanced cost of capital approach. And really, it's not that enhanced, right? All I do is bring in indirect bankruptcy costs by connecting your operating income to what your rating is. Today, I want to complete the story. So I've got an optimal debt ratio for Disney. Let's see where we are so far. With the cost of capital approach, I got 40%. With the enhanced cost of capital approach, I got 40%. There's a third approach I want to talk about today called the adjusted present value approach, or the APV approach. If any of you worked at investment banks or maybe a consulting firm, I wouldn't be surprised if your managing director, especially if you went to Chicago, she went to Chicago, said, the way you compute the optimal debt ratio for a company is the APV approach. This cost of capital approach is complete nonsense. I'm going to take that argument apart today. Let's talk about what the APV approach does that's different from the cost of capital approach. Think of what debt does to you as a company. The biggest advantage of debt is a tax advantage, right? The tax benefits of debt. The biggest disadvantage of debt is the expected bankruptcy cost. In the APV approach, here's what you do. You start by valuing your company as if it had no debt. It's called an unlevered firm value. And I'll take you through the process of doing that first. So this is the value of your company with zero debt. And then it takes the dollar debt you have as a company, 10 billion, 20 billion, 30 billion, and it does two things. One, it computes the expected tax benefits from that debt, which comes from the interest expense being tax deductible. And it also computes the expected bankruptcy costs. So here's what the APV value for your firm is. It's your unlevered firm value, the value of your firm with no debt, plus the tax benefits of debt, minus the expected bankruptcy cost. And you try to maximize your value of the firm. That objective remains unchanged. Looks simple enough, right? Let me take you through the 3 steps, and I'm going to talk about where the weakest link in this approach is. The first step in this approach is to compute the unlevered firm value. There are 2 ways you can estimate the unlevered firm value. One is to take your cash flows to the firm and discount it back at the cost of capital you'd have had with zero debt. That's actually pretty simple to come up with, right? Because when you have zero debt, what's your cost of capital? It's your unlevered cost of equity. Remember that unlevered beta we used? You can come up with an unlevered cost of equity, which is also your cost of capital. So you can discount your cash flows to the firm at that unlevered cost of capital to come up with an unlevered firm value. But that is work, right? Because you've got to do a full-fledged valuation. Here's a cheating way to come up with the unlevered firm value. You could start with the existing market value that you have for your company, market cap plus debt. Remember, you added up the values, you came up with the total enterprise value. And then ask yourself, if I had no debt, what will happen to that enterprise value? What will that mean? You'll have to take out the tax benefits of debt because you will no longer have the debt, and you will add back the bankruptcy cost because you won't have those costs. So in other words, you're backing out from the firm value what the unlevered value of the firm would be. I know it sounds incredibly abstract, but I'll try that at Disney. So the first step is to get the unlevered firm value. Step two, you got to come up with the expected tax benefits from the debt. And this should be relatively simple. It's the interest expense on your debt that is tax deductible, right? And your tax savings are very simple. It's the interest expense times your tax rate. So if you have 100 million interest expenses, you have a 25% tax rate, you're saving 25 million that year. Compute the present value of those tax savings over the rest of time, and you got the present value of the tax benefits from borrowing money. Of course, you got to make assumptions about what tax rate to use going forward. So in a year like 2021, you're facing a quandary, right? Because right now it's 21%, but you don't know if there will be a change in the tax code that makes it 25 or 28%. And you also have to make an assumption about what discount rate to apply on those tax benefits. Because remember, you're going to get tax benefits not just this year, but 2 years from now, 3 years from now. So we'll talk about the choices we make and how sometimes you get different choices on those. That gives you tax benefits. So far, so good. You got the unlevered firm value, you got the tax benefits. Now comes what I call the nightmare portion of APV, coming up with expected bankruptcy costs. Because here's what you need to come up with an expected bankruptcy cost. You got to assess a probability that your company will go bankrupt. Already we're talking about how do I do that? How do I come? I'll give you my some ways to do that, but you need that, a probability of bankruptcy. And second, you need to come up with the cost of bankruptcy, including those indirect costs we talked about, where people stop buying your product, your employees leave, your suppliers demand cash. That part is a nightmare to estimate. Now, here's why. When people claim to use the APV approach, I think they're mostly half-assing it. Here's what they do, and here's what I've seen investment bankers do. They'll do the unlevered firm value. They'll do a song and dance, but it's doable. They'll do the expected tax benefits. Again, not a big deal. They'll do it. And then they'll get to the expected bankruptcy costs. You know what they do? They say it's too difficult to estimate. We're going to ignore it. Let me ask you a question. If in your APV approach, you start with the unlevered firm value, add the tax benefits, and you ignore the expected bankruptcy costs, how much money should a company borrow? What's your optimal debt ratio going to be? Lee, what do you think?
I would say you would probably want to borrow a lot. There's
All
no
of it,
downside.
right? Because I'm letting you count the good stuff. And I'm saying just ignore the bad stuff. Of course I'm going to borrow. This is why APVs and LBO guys' favorite mechanism for computing how much you should borrow. Because in his word, 95% debt, not a big deal. Of course it's not a big deal. You've ignored bankruptcy costs. So if anybody pushes you on APV, first make sure they're not half-assing it by counting only the tax benefits, and then teach them how to do APV. And they're very quickly going to say, you know what, this is really tough to do. Let's bring in the expected bankruptcy cost. To get the expected bankruptcy cost, I need two items. I need the probability that you will go bankrupt, not just at existing debt ratio, but at every conceivable debt ratio. So I need a probability of bankruptcy. So I'm going to take you through a process by which we can estimate probability of bankruptcy. And I think it's doable. And then you have to come up with the cost of bankruptcy, and there are two components. One is that direct cost. Remember we talked about being in the legal system and how it sucks up your value? That cost is about 5 to 10% of firm value. There are studies that show it's, if you look at any going concern, the direct cost, the legal cost is about 5 to 10%. The indirect cost, though, varies widely across companies. I don't know whether you remember, but you talked about a grocery store versus an aircraft manufacturer. How the indirect bankruptcy cost for a grocery store can be low, maybe only 5 or 10%. And for an aircraft manufacturer, it can be 20 or 30%. I'll be quite honest, there is no research right now that I can point to that will let you estimate this number precisely. There's a reason why the cost of capital approach remains my basic approach. It's not because I don't see how the APV approach works, but because this single item is so difficult to estimate, the indirect bankruptcy cost, that it becomes a complete crapshoot. But let's say you run into one of these pures and he says, look, I don't believe this cost of capital approach. Show me what the optimal debt ratio for Disney would be with the APV approach. Let me lay the foundations. I now need an estimate of the probability of bankruptcy at every debt ratio, right? Here's how I'm going to do it. Remember how we got the synthetic rating for a company at different debt ratios? We did the interest coverage ratio and said this company is going to be triple B at 30%, double B at 40%. If I can estimate a rating for a company, in a sense, I'm also estimating a probability of default, and here's why. We've had ratings now for a century. Moody's and S&P started rating companies in the 1920s. We also have a century of real data on what percentage of companies in each ratings class actually default. Because we can track them over the last 100 years. If you go to the Moody's and the S&P website, you can get updated values for this. And guess what? Higher rated companies tend to default less than lower rated companies. Thank God for that. Otherwise, the ratings agencies are completely useless. This is from Ed Altman, who teaches at Stern. This is the focus of his research for the last 50 years, is default risk. Actually used to update these probabilities every year. I don't know whether he's done it for the last couple of years, but I can send you a link on Moody's because you can get the updated numbers, where he estimates the probability of default for each ratings class over the next 10 years. So he goes back 10 years ago, looks at bonds that are rated AAA, AA, then looks at what percentage of those bonds default over the next 10 years. So guess what? If you start off with AAA rated companies, over the next 10 years, the probability of default is 0.07%. You know what? When I first saw this table, I was surprised it wasn't zero, because what are we told about AAA rated companies? They almost never default. Almost never is the key word. They sometimes, it's very rare, 0.07%. As you go to triple B, that rises to 7.5%. A typical investment grade bond, 7.5% of those bonds default over the next 10 years. You go to single B, it's 37%. You see how this table is going to help me? At every debt ratio, I'm going to compute a rating. I'm going to take this table and say, with that rating, this is your probability of default. I've got half the expected bankruptcy cost nailed down. Let's try this on Disney. I'm going to start off by trying to estimate Disney's unlevered firm value. To do this, I'm going to cheat. I'm going to start with the existing value for the firm by adding up the equity and the debt. So 137.9 billion is the total market value of the firm today. So that's a market cap, that's a market value of debt. As I do this, if you want to think in parallel, whether you could do this for your company, I'm not going to ask you to do the APV approach because, as I said, its biggest number is flawed. But if you want to think about doing it, this current number you should get for your company, market cap plus total debt. And here's the question I'm asking. If Disney had no debt, what would the value of the firm be? So here's the first thing I do. I subtract out the tax benefits I would have on this 15.96 billion. Why subtract it out? Because if I have no debt, there'll be no tax benefits. And the shortcut that I'm going to use is I'm going to multiply the dollar debt by the tax rate. Now, this seems crazy because you just get the tax deduction of the interest expenses, but it turns out that if you take the present value of those tax benefits over time, the shortcut actually works pretty well. You have $1 billion in debt and a 25% tax rate. Roughly speaking, the present value of your tax benefits is going to be 25% of $1 billion, which is $250 million. So I'm subtracting out the tax benefits from debt. Let me pause there. Is everybody clear on why I'm subtracting it out? It's because without the debt, I'd lose the tax benefits. But I do get a bonus, right? If I take the debt off my books, I'm no longer going to have the bankruptcy cost that goes with that debt. So here's what I do. I add back the expected bankruptcy cost. And to do that, I estimate the probability of default given Disney's rating. I don't know whether you remember, but Disney's rating was single A. The probability of default is 0.66%. You can go back and look at single A rated bonds, 0.66%. I subtract out that 0.66%. of my cost of bankruptcy. And here I'm going to be completely honest. I've estimated that cost of bankruptcy to be 25% of firm value. Why? I just made it up. I just made it up because I really have no idea. The research suggests that the cost of bankruptcy can range anywhere from 10 to 40%. I put it right in the middle. I don't think it's Boeing. It's not the 40%. I don't think it's Kroger's, which would be the 10%. I'm putting it in the middle because some of its businesses might be affected, some might not be, 25%. What I get as my unlevered firm value for Disney is 132.3 billion. You're saying, what does that tell me? In my judgment, if Disney had no debt, they were all equity funded, their value as a company would be about $5.5 billion less than it is today, 132.3 billion. That's going to be my starting point. Michael?
Are we using the synthetic rating for Disney given that there will be zero debt?
No, because this is basically, I'm taking out the debt that they actually have. So the question you're asking is if they didn't have the existing debt, right? So the bankruptcy cost I should be taking out should be the bankruptcy cost associated with their existing debt. After I've done it, I have no debt. Then if you ask me what's the expected bankruptcy cost, I'm going to give them a AAA rating because they have no debt. But while I'm doing this, I have to remember they do have 15.96 billion in debt. So in this part of the process, you will actually use their actual rating at the existing debt ratio to come up with the bankruptcy cost. So what's the next step? Once I have the unlevered firm value, I'm going to try to estimate the value of Disney at every debt ratio from 0 to 90%. So let's take the easy number first. Notice the unlevered firm value is the same because that's going to be what it is. And in fact, at 0% debt, my unlevered firm value becomes close to my levered firm value because even if they go to 0% debt, the rating can't be higher than AAA. And if you remember, even AAA rated companies have a teeny amount of default risk, 0.07%. So to Michael's question, once they've paid off the debt, the default risk drops to almost nothing. Expected value of the firm is 132.28 billion. That is if they have no debt. If they go to 10% debt, they get a tax benefit. That tax benefit reflects the fact that they're going to be borrowing 13.78 billion. That multiplied by 36.1%. So the tax benefit is always 36.1%, which is the marginal tax rate times whatever dollar debt they take. So you go across as they increase debt, the tax benefit goes up. The only thing is at some point in time, remember they ran out of interest of operating income to cover their interest expenses. We did this with the cost of capital approach as well. So at some point that tax benefits level off and actually start to decrease. I also assess the rating. Why do I need the rating? Because the rating is what's allowing me to come up with the probability of default. And no surprise, as I borrow more money, my probability of default increases. In fact, by the time I get to 70 or 80% debt, I'm looking at a 59, 60% chance of failure. You multiply the probability of default by the value of the firm, you come up with an expected bankruptcy cost. And again, intuitively, you can see my expected bankruptcy costs climb, especially as I get past 40% debt. Again, there's this cliff, which I want to avoid, right? And you saw this with the cost of capital approach as well. At 40%, all hell breaks loose. Everything starts to implode on me, and you can see that show up. And if I look at the value of my firm, as I borrow money initially, it goes up. It peaks at about 40% debt, and then it implodes. This is pure coincidence that my optimal debt ratio with the APV approach is 40%. If that sounds familiar, that's what I got with the cost of capital approach and the enhanced cost of capital approach. But you know why you should be suspicious? What's driving this 40% optimal? My 25% bankruptcy cost. And what did I say about it? I made it up. How do you know I didn't try 15% and I got a different debt ratio? And I said, that's so difficult to explain away. Let me try a higher, so the two debt ratios look the same. I'm not going to fool you by saying the two approaches will give you the same answer because it depends on your bankruptcy cost assumption. But I want you to get the intuition because I really want to weaponize you against that person who shows up in your team who says, we're going to use the APV approach. Go along with them. But if they stop after tax benefits, say, no, this isn't the APV approach. We've got to bring an expected bankruptcy cost. And that person says, What expected bankruptcy cost? That's revealing because it tells you something about how little they truly understand the APV approach. Dan, you had a question?
I was going to say you could see the huge increase from like the probability of default from 0.66 to 45% when it's not investment grade anymore. So triple B, after triple B negative, it's not going to be investment grade anymore. Do you think
because what happens is this is that indirect bankruptcy cost starting to kick in is you get into trouble. It starts to put you even more into trouble. So it starts to very quickly spiral out of control. And that's why if I were advising Disney, you know what I'd ask them to do? Stop at 30%. I don't want to mess with that 40% and end up being too close to the cliff. Because that's basically what it is, right? You hit that cliff, you come, and you're going to see this with most companies. There will be a cliff in your cost of capital as well, where you see the cost of capital start to climb. You want to avoid that cliff as much as you can.
Okay.
Kushal?
Professor, can you just explain one more time how you calculated the expected bankruptcy cost in this table?
So what you do is you take the probability of default, multiply it by the unlevered firm value plus the tax benefit. So you add those two numbers up, you get the value of the firm with no bankruptcy cost. So for instance, if you take 132, let's take a middle number, 132 at 50% debt, they were 132.3 as the unlevered firm value, 24.88 as your tax benefit. So adding those two numbers up, you get about 156 or 158. And 50% debt, you have a 45% chance of failure. So there's a 45% chance your company could be essentially be worth nothing because your equity kind of implodes. So you take 55% times, so that 45% times the value of your company is the expected bankruptcy cost that you see there. You got to also multiply by 0.25. Remember that the cost of bankruptcy is not the entire value of the firm. So you take the value of the firm, multiply by 0.25. That brings the cost of bankruptcy multiplied by 45%, which is the probability. That should be your expected bankruptcy cost. So the intuition is as you borrow more money, you expose yourself to a greater chance of failure. And if that happens, you lose everything. You lose the unlevered firm value, you lose the tax benefits, and I'm bringing them into the game. So at this point, we're getting a 40% debt ratio using the cost of capital approach, the enhanced cost of capital approach, and the APV approach. Now, if you look at these approaches, I mean, this isn't rocket science, right? I mean, none of this should be, you can't say, look, you need a PhD in finance or mathematics. You don't need it. You just need about 2 hours of time and thinking through this to come up with the optimal debt ratio for your company. And if you're a $50 billion company, a $100 billion company, a $1 trillion company, as some of you are tracking, do you think it's worth a couple of hours figuring out how much can we borrow? I would think so. You'd think that most companies use something like this to come up with their optimal debt ratios, but they don't. You know how most companies decide how much to borrow? They look at everybody else in the sector and say, what are they doing? Oh, they're borrowing a lot of money? We're going to borrow money too. If they're not borrowing money, we're not going to borrow money either. They approach deciding how much to borrow the same way a 6-year-old approaches life. If any of you have 6-year-olds at home, and remember when you were 6-year-old and you came back home from kindergarten and your mother asked, why did you do that? That was really stupid. And your answer was, Mom, everybody else was doing it. To which you get the classic mom response, right? Dads never give this response, moms do. If everybody else jumped off a bridge, would you jump off the bridge too? To which if you're a normal 6-year-old, you know what the answer is? Of course I would. Do you want me to look strange? And in effect, that's almost the answer you get for companies. Why do you guys borrow so much money? Because that's what everybody does. Aren't you worried they might be doing this stupid thing? No, we want to look like everybody else. There's a behavioral reason why companies like to be close to the rest of the industry. It's the safest place for you to be as a CEO or a CFO. Do you see why? Let's say everybody else is borrowing too much money and you borrow too much money too, and you get into trouble. You know what the defense is? Don't blame me. Everybody was doing it. I understand this push towards being close to the industry. Every company I've ever talked to, about optimal debt ratios. I'll go through this cost of capital approach and I'll say your optimal is 30%. You know the first question the CFO always asks? If we go to 30%, will we look strange? You know what he's talking about, right? That when an analyst compares the 30% they have to everybody else in the group, will we look like an outlier? And you got to be prepared for that answer, even if you don't agree with that approach. So let's lay out some intuitive reasons why, even within a group, you should expect debt ratios to be different. Let's take entertainment companies. Disney is part of a big group of entertainment companies. But I would expect Disney to carry more debt than the typical entertainment company. And here's why. The first is it's a much more diversified company in terms of entertainment business than somebody like Lionsgate. Lionsgate makes one big blockbuster movie every 2 years, and if it makes a lot of money, it feels it does well. And if it crashes, they go through a couple of years of scarcity. I would expect Disney to borrow more money because they're larger, they're safer, they're more stable. In fact, if you think about the trade-off we laid out for debt, we can already start to draw some implications into what kinds of companies within a sector should borrow more money. If you're a company that faces significantly higher tax rate than every other company in your group, or a significantly lower tax rate, I would expect your debt ratio to be different. If you're looking at Ryanair against other European airlines, I would expect Ryanair to borrow less money for a simple reason. Their marginal tax rate is only 12%, whereas Lufthansa faces a tax rate of 28 or 29%. Second, remember we talked about the disciplining benefit of debt, that if you're a company with a separation between ownership and management, I would push you to borrow more money just to make you more disciplined. So if you're a company where insiders run the company, a founder is the CEO, and activist investors on board, I would expect you to carry less debt than if you don't have an internal disciplining mechanism. So I want to look at what percentage of the shares are held by insiders. If a very small percentage is held by insiders, I would expect you to borrow more money simply because you need debt to discipline you. You don't have somebody within the firm saying, don't take that project. If your income is more stable as a company, I would expect you to borrow more money than if your income moves around. That's pretty intuitive, right? If you have unstable income, you don't want to go out and borrow money. And finally, remember we talked about agency issues, that if you're a company where the bulk of your assets are intangible, I can't see them, I would expect you to borrow less money than if you have tangible assets. I mean, let's suppose I compared Uber to a traditional taxi cab company. Traditional taxi cab companies, you buy the cars, you put them on the ground, you hire drivers to drive them, but you own the cars. It's capital intensive. Even without looking at the numbers, I would expect the traditional car service company to borrow more money than Uber because Uber doesn't own the cars. They're essentially a connecting company. So when you look at companies, even successful companies, which are just intermediaries, Airbnb should borrow far less money than Marriott, even if they make the same income because of the nature of their assets. What I'm saying is if you decide to do a comparison of your company to the industry averages, those are things you want to bring in, because when your company has a much higher or lower debt ratio, before you jump to the conclusion that they have too much debt, you might want to ask the question, is my company different? On my website, I report industry averages for like 94 industries. And you can do this. You go to Capital IQ, you can pull up the debt ratios of every company in your group. See whether it looks different. I did this for my companies. Disney's actual debt ratios are right here. And I'd use different metrics because I don't know what you compare yourself to, book value, market value, whether you use net debt or gross debt. So I've done 4 different debt ratios based on gross debt and net debt, market value, and book value. And I've compared them to what the rest of the sector looks like. So let's take Disney. Remember, by this point in time, what am I finding in Disney? That it has too little debt, right? The cost of capital approach found that it had too little debt, the enhanced cost of capital, and the adjusted present value approach. I'm trying to sell this to Disney. I know the question they're going to ask is, if we do this, are we going to look strange? We go to a 40% debt ratio. Well, I have some good news, because right now it looks like Disney, if you compare to the rest of the entertainment sector, based on every measure of debt ratio, has too little debt. You see how this makes my sales pitch much easier? Because when I go to Disney, I can say, look, guys, you should have more debt because your cost of capital is lower. And by the way, you're also underlevered relative to everybody else in the sector. With Vale, again, I find debt ratios that are higher than the industry average in every single measure of debt ratio, which again reinforces the point I made. Vale looks overlevered. And by the way, you can't use the excuse of iron ore prices are down because I compare you to other companies. You still look overlevered. With Tata Motors, I get overlevered on every single dimension. I got incredibly lucky here because every single one of my peer group comparisons reinforced what I found in my cost of capital approach, that they were underlevered or overlevered. Jeremy?
But your comment about how if there's a red flag, you should look and see, why you're different. Why is Disney different? Doesn't that kind of open the door, though, to if this is what the CEO wants to do and not listen to anyone, or if this is what the advisor wants to do and not listen?
You could explain away pretty much everything. It does, and that's why I think it makes sense, even if you don't buy into it, to do the cost of capital approach. I tell companies, look, you don't want to use it, that's okay. But this will then act as a disciplining mechanism where when you come up with these odd excuses for why you never borrow money, you now have something else you have to fight me on, because I'm going to bring in the numbers that tell me where in this cost of capital approach am I missing what you claim to be this unique feature as a company. But I agree, once you go down that subjective column, CFOs are going to reinforce whatever their priors are. That's a problem with storytelling in general, right? In fact, this shows up in pricing as well. When people look at PE ratios for companies relative to the peer group, they have exactly the same issue, which is they tell stories to explain away why I should pay a much higher multiple of revenues for PayPal as opposed to other financial service companies. It's easy to kind of reinforce your priors when all you're doing is storytelling. Ashwin?
Professor, sorry if I missed this, but looking at Disney's comparable group, I know Disney is also in different industries. So would it make sense to do something like we did with the unlevered beta, where we look at the different industries they're in?
Don't go unlevered beta. If you want to bring in the different industries, break them down by division. The only problem is they don't break debt down by division. So you're going to face the same challenge we did with levered betas, but get a debt ratio by division. Look at the peer group by division, right? So you can say, are Disney theme parks more or less levered than the typical theme park company? So basically you can do this on a division level, but you need some information on debt at the division level.
Got it. Okay, thank you.
Now, Jeremy's point is a very good one, which is if you let the CFO eyeball the data, they're going to make up all kinds of stories to explain away what they're doing. You know what I found to be the mechanism that best fights back is don't argue with them about the story. You're always going to lose. So, okay, you tell me you're borrowing less because you have a lower tax rate. Let's see if that explains how much you're borrowing. And the tool I'm going to use is actually a very simple tool, because what I'm trying to do is explain differences in debt ratios across companies. And I know what drives those differences: tax rates, how variable your income is. I'm actually going to take your peer group. I'm going to run a regression of the debt ratios of companies against the variables that I think should matter. And there's a judgment call you got to make, tax rates. And so you got to decide what you think matters in this sector. When you run a regression, what are you going to get? You're going to get at least a sense of what is it that drives debt ratio differences across companies within this peer group. And then I'm going to plug in your company's lower tax rate and higher standard deviation. And I'm going to come up with a predicted debt ratio. Remember, this predicted debt ratio is all your stories already embedded in it, right? Your low tax rate, the high risk. And let's say your predicted debt ratio is still much higher than the actual debt ratio. I've taken away your excuse, right? Because I've controlled for the fact that you have lower tax rates and more risk, and you're still borrowing too little money. Let's try this. I took Tata Motors, and I wanted to ask the question. Remember, I found Tata Motors to be over-levered using the cost of capital approach. I wanted to see what their borrowing looked like relative to other automobile companies. I did the simple comparison, but I want to dig a little deeper. So I took 56 global auto firms and I ran a regression of debt to capital. So this is the market value debt to capital ratio that we've been using against effective tax rates. And my intuition there was the higher the tax rate, the more debt you should have. How much cash flow they had, because you need more cash to service debt. Companies that have a lot of cash flow, and I'm using a very generic measure of cash flow as EBITDA. And I'm also going to make the hypothesis, if you're a growing company with a lot of future investment needs, you should be a little more wary about borrowing money, because we talked about flexibility, that you need debt. So the signs all had this, all the coefficients had the right signs. Higher tax rate companies had higher debt ratios. The more cash flow generated as a company at the higher debt ratios. The R squared of the regression is 21%. Am I disappointed? When I do regressions with financial numbers, I'm neither exhilarated nor disappointed. It is what it is. This is what the data is telling me, that 21% of the variation in debt ratios across companies can be explained by these variables. Would I like it to be 90%? Absolutely. There are some sectors we'll get very high R squares because the differences are driven by fundamentals. And there are some sectors where there's nothing fundamental that explains them. But then R squared of 21% is still going to give me a prediction. In this case, the prediction I get if I plug in Tata Motors numbers for tax rate, enterprise value, and CapEx into that regression is 18.54%. You think, what does that tell me? Given how other automobile companies are borrowing money, given their debt practices, I would expect Tata Motors, given its differences on many dimensions, to have a debt ratio of 18.5%. Remember when I did the cost of capital approach, I came up with an optimal of 20 and their debt ratio was 29, and I told them they were over levered. And they said, we don't use that cost of capital approach, too many assumptions. I'm going to come back at them and say, okay, I've come back with a different approach. Given how other automobile companies are borrowing money, and given the fact that you might have a different tax rate and cash flows, your debt ratio should be 18.5%. You're over levered. Still, without using any kind of what you might call theoretical approach, this is basically driven by what other companies are doing. At the start of every year, and I'll put up the 2021 regression soon, I'll put it up probably today or tomorrow, I do a very simple regression over the entire market. In other words, I'm trying to explain differences in debt ratios over the entire market. So this was the 2014 regression, because that's when I was looking at Disney. I took debt ratio, that was a variable I'm always trying to explain. And I used the following variables. With each one, I'm going to ask you what I'm trying to capture, because with each one, I'm coming up with a variable to capture what I think should matter in terms of driving debt ratios. The first variable I used was the tax rate. Which component of the tax, or the trade-off, am I capturing here? That's capturing the tax benefit of debt. The higher the tax rate, the more debt you should have. I threw in growth into the regression. Why do I care about growth? Because higher growth companies should borrow less money because they're worried about financial flexibility and everything being in the future. I threw the percentage of shares held by institutions. Again, is a rough proxy for is somebody keeping an eye on management. I threw in the variation in operating income to capture how uncertain I was about operating income. The higher this number, the more volatile my income. My riskier firm should borrow less. And finally, I threw in EBITDA just to get a measure of how much cash flow this company had to service debt. I'll give you the bad news first, and then I'll give you the good news later. It took me about an hour to run the regression. At the end of it, I said, did I waste my time? The R squared was 8%. So that's a kind way of saying I'm not explaining 92% of the variation in debt ratios across companies. But if you made this your hill to fight on, you know what my response is going to be? I wanted to use the cost of capital approach to compute the optimal debt ratios. You're the one comparing yourself to everybody else. And guess what? This is all noise. Why the heck would you want to borrow money based on this comparison? Companies seem to have no idea why they're doing what they're doing. But if you force me to use this regression and I plugged in Disney's numbers, and I took that regression that you saw and plugged in Disney's tax rate, its revenue growth. So basically what you saw in the regression, I plugged in Disney's numbers. The predicted debt ratio that I got for Disney was about 19%. What does that tell me? Given how other US companies are choosing to borrow money, Disney should be at a 19% debt ratio. That's well below the 40% I got with the cost of capital approach, but it's well above the 12% that they have as their actual debt ratio. They're still under-levered, but maybe not by as much as I'm getting from the cost of capital and the APV approach. So maybe when I try to sell my recommendation to Disney that they're underlevered, this is going to come into play. So right now you're at 12%. I come to them. In fact, I had this very simplistic operating income approach where I looked at I asked them what is the probability that you want for your operating income not to drop below zero? And then I estimate how much they can borrow. But you saw the cost of capital, the APV, and the enhance all gave me 40%. When I did a sector regression, which I didn't show you, where I took entertainment companies, my predicted debt ratio for Disney was about 29%. And when I did the market regression, the previous page, I got 19%. You're saying the numbers are all different. They are. But the direction is always the same, right? Disney looks underlevered no matter how you slice and dice the data. Whether you push them to 20% or 40% is going to depend on which approach you're going to hang your hat on. But even if you said, I just want to be like everybody else, Disney's debt ratio should be about 20%. When I did Vale, their actual debt ratio was 35%. Using their actual operating income, they were over levered. But if I use some kind of normalized version, then I could get away with saying, hey, they're at the right debt ratio. APV approach, I got 30%, they're over levered and relative. So if I were to make an overall judgment about Vale, here's what it would be. They're slightly over levered, not massively over levered, they're slightly over levered. And if iron ore prices come back, that might go away. But for the moment, given their capacity to earn money, they're on the wrong side of the optimal, but not to a point where I'm going to do something crazy. With Tata Motors, their actual debt ratio is 29%. Every approach that I tried gave me an optimal debt ratio that was much lower. Again, the numbers might be different, but my recommendation is you are over levered, you have too much debt, and maybe using the Tata family group borrowing capacity to be able to get away with it, but as a standalone company, you have too much debt. So Disney looks underlevered, Vale and Tata Motors look overlevered, not massively so. And then you get to Baidu. Its actual debt ratio is 5%, its optimal is about 10 to 20%. But with Baidu, your sales pitch is going to be much more difficult, and here's why. Even though they have the capacity to borrow money, you know what's going to get in the way when you try to get them to borrow money? They're in a sector where companies just don't borrow money. Based on the sector, they should be about 2% debt. This is a case where I would expect you, if you go in and make your, so let's say you tell me you're going to go in next week, you're going to make a pitch to Baidu, they should borrow money based on your cost of capital approach. And you ask me just for my honest opinion on are they going to buy my sales pitch? My answer is probably not. You're going to have a tough time doing it. And now you can see why with technology companies, it's so difficult to get the debt ratio to go up because nobody else borrows money. You're saying, but technology companies are risky. Hey, look, you looked at Google for your case, right? I think of Google as this incredibly profitable company with remarkably predictable income, and its debt ratio is like 1.6%. You see, what's holding them back? What's holding them back is very few tech companies borrow money. And when nobody else borrows money, it becomes much more difficult to convince companies to go out and try to be the first one there. Ding?
Hi, Professor. I have a question on the earlier slide.
Yeah. Which,
So,
how far earlier?
Yeah, just this slide. So the coefficiency with effective tax rate is negative here, but a slide earlier, the coefficiency was positive.
No,
Just trying
that was a
to
different
understand.
regression. In this regression, it's
Yeah.
negative. On the previous regression, the global auto, where do the coefficients come from? They come from your data, right? You don't control them. I agree with you. You'd expect the tax rate to have a positive coefficient. But one thing to remember is don't fight the data. The data says, at least in this sample, higher tax rate companies actually borrow less money. You're saying that makes no sense? It isn't, whether it makes sense or not becomes irrelevant. Once you've entered this pathway of saying, I am going to let the way other companies behave drive how I behave. If they do crazy things, guess what you're going to do too? You're going to do crazy things as well. That's one of the prices of going down this pathway. So it is true that the coefficient has the wrong sign, but don't do anything crazy of saying the sign doesn't make sense. I'm going to make the minus into a positive. You can't do that, right? The data gave you this regression. And there's actually a reason for this. Do you guys remember the word multicollinearity from your statistics class? Multicollinearity is when independent variables in a regression are correlated with each other. In a regression, that's not supposed to happen. But in this regression, think about it. These variables are correlated with each other, which means you can get strange looking coefficients because the computer is not sure what variable is measuring, what is proxying for what. So the coefficient sign might be wrong, but there's not much you can do about it. It is what it is. The data spits it out. Sushant?
So I want to ask, so you got a single value for the debt ratio, right? Just was wondering if it would be like a band or like what would be the error?
You know what gives it away? You know what determines the band, right? When is there going to be no band at all? What's going to be true about the R squared of your regression for your prediction to be absolutely perfect?
R squared to be 1.
R squared has to be 100%. When your R squared is 8%, it's not that you can't make predictions, but your prediction is going to, in fact, if you have any statistics package, it'll give you both a predicted value and it'll give you a 90% confidence interval. In this case, that confidence interval would put me somewhere between 14 and 25% in the case of Disney. Why is it so big? Because the R squared is only 8%. So in fact, if you use a regression, not only can you get a predicted value, you can get a band. And you're right, if you're within that band, I can't rule out the possibility that you're correctly leveled. So let the data tell you what the band is. You don't have to make judgment calls. It'll actually come right out of the data. Okay, so let's say you are at this stage of the process, and some of you are, because I've seen your capital structure spreadsheets. You come up with the right mix of debt and equity. Let's now talk about what to do with that optimal. In fact, at the end of your analysis on your company, one of three things is going to be true. I talked to Cody and Michael because they joined before everybody else did, about like 6 minutes ahead. So I asked Cody, who's doing Domino's, what his optimal debt ratio was, and he said it was 20%. And I asked him what the actual was. It's 22%, which means that Domino's is at the optimal. I asked Michael, who's doing Coca-Cola, what his optimal debt ratio is. About 10 to 15%. They're at 17%. They're at the optimal. When you're at the optimal, what should you do? Follow the Hippocratic Oath. What's the Hippocratic? Do no harm. If a company is already doing the right thing, just say you're doing the right thing and walk away. It seems like an obvious thing to say, but you know how difficult it is? You're hired as a consultant. Let's say you hang up a shingle, capital structure consultant. Domino's calls you in. You say you have a secret model, but basically running a cost to capital approach. You come up with the conclusion that Domino's is at the optimal. You know how awkward this is? You're the expert. They've called you in to assess their optimal. If you could just go in and say you're already at the optimal, it sounds like you're not that much of an expert, right? So what do? You make up crap. You say, you know what, you should tweak this, you should change that. Do no harm, because if a company is already doing the right thing, leave it alone. But some of your companies are going to be under-levered. Their actual debt ratio is much lower than the optimal. So if you're doing Google, I'll predict safely you're going to be under-levered. If you're doing Apple, you're going to be under-levered. And some of your companies will have too much debt. I don't see Shoyu in the group. He might be on the next page, but he's doing MTN, South African telecom company. Their actual debt ratio is 56%. Their optimal debt ratio is 20%. This isn't some minor noise factor. So some of your companies are going to be under-levered, some are going to be over-levered. Before we look at what to do next, which is a better problem to have? Too little debt or too much debt? Mallory, what do you think? What's better to have, too little debt or too much debt? Go with your gut. Would you rather have $1 million in student? Too little debt is a much better problem to have. You have a luxury of things you can do. too much debt is, I mean, imagine if you, it's not just true for companies, right? As an individual, would you rather have of course I'd rather have too little debt. There are all these great things I can do if I have too little debt. Too much debt, my choices become narrower. But when your debt ratio is different from the optimal, there are two questions you need to answer. One is, do I need to do something right away? Is there urgency involved here? And we'll talk about what drives that urgency. And second, assuming you decide to move to the optimal, some of you might decide that even though your actual is different from the optimal, that there's really no point moving to the optimal because the change in value you get is so little that it's not worth going from 20 to 40% debt to lower your cost of capital by 0.05%. But if you decide to move to the optimal, you also have to address the question, how am I going to do it? And you can say, what do you mean, how am I? I'm going to give you different pathways of moving to the optimal. Which one is right for you will depend on your company. So let's start with the first question. You do your assessment. Is the actual debt ratio greater or lesser? If it's close, then you're obviously not even in this flow chart. Let's assume you have the better problem. You're under-levered. You have too little debt. When you're a company with too little debt, you know where you should worry? You might become the target of a hostile takeover. And let's think about why. Why would having too little debt as a company make you into a better potential target for a takeover? Jonathan, you want to try? Why would having too little debt make a company a potential target for a takeover?
Sure. So it's similar to having too much cash, where if you have too little debt, it's sort of like free money where you can take over the company and then take on debt, and then it becomes a rebate on the back end.
You made it easier for somebody. I'll give you an analogy. It's not going to work, but kind of bring it home. Let's assume you buy a house or an apartment in the New York area. That's going to cost you, what, 3 million, 4 million, 2 million. So it's going to cost you millions. So let's say it's going to cost you 2 million. And you are an incredibly frugal person. You save every dollar you make. And 3 years into this, you've paid off your entire home mortgage. You now own the only all equity financed house in your neighborhood. And you decide to have a mortgage burning party. Have you heard of these things? In the old days when people used to take 30-year mortgages, on the day they paid their final mortgage, they'd invite all the neighbors over with coffee cake and orange juice, and they'd actually physically burn the mortgage papers. Once in a while, they'd burn the house down with the papers, but that's kind of tragic when it happens. So you decide to have a mortgage burning party. So you invited all your neighbors over. You have lots of coffee cake. Obviously, this is going to be post-COVID, so don't do anything to break the law. And you even invited the neighborhood fire people, just in case there's a fire, you have somebody there who can. And while your neighbor Bob, this is a guy who lives next door to you, he's never liked you. He doesn't like the way you cut your lawn, the shrubs you pick, just in general, he doesn't like you. And while he's eating your coffee cake and drinking your orange juice, he's plotting his revenge. So after the party, here's what Bob does. And this is where you got to abandon the way the world actually works. He says, no way can he do this. Bob walks over to the local neighborhood bank. And he says, you know what? My neighbor's house, which is worth 2 million, is all equity financed. Will you lend me 1.6 million against this house? If you tried this in real life, you went to a bank and tried to borrow money on your neighbor's house, what's your banker going to say? It's not your house. You can't go around borrowing money on other people's houses. But let's say this is your friendly neighborhood banker. He says, here, Bob, you can borrow 1.6 million. He's using your house to borrow 1.6 million. And then he mounts a hostile takeover of your house. Again, I'm not sure how this would work, but he approaches your kids with special deals. You sell your share of the house to me. You can have the entire attic to do whatever you want. You can have the basement to play Fortnite for the rest of eternity. And one by one, your kids abandon you. And before you know it, your neighbor Bob now owns 60%. Your 3 kids all sold their 20% shares. He's accomplished this hostile acquisition of your house. He throws you out. This can't happen with a house. But imagine being the CEO of a publicly traded company that's worth $1 billion, and you're a very conservative CEO, you refuse to borrow money. Why? Because you hate debt. It has no debt. And let's say this company can actually carry $600 million in debt. Somebody notices, and they go to the bank and they try to borrow money against a company they don't own. The reaction they're going to get is the same one you got when you try to borrow money in your neighbor's house. You can't borrow money against a company you don't own. Until 1980 or so, the tyranny of the local neighborhood banker kept you from doing this. But there's an outfit created in New York called Drexel Burnham. You know what Drexel Burnham created that allowed you to borrow money against things you did not own? Anybody? What is Drexel Burnham's most famous or infamous invention? The junk bond. The junk bond. Until 1980, if you want to issue bonds, you also always had to issue it against assets, against a company. What Drexel Burnham said, you can issue bonds with no security, but based on a promise that you're going to try to take over somebody. It's a junk bond. So obviously the rating is low, the yield is high, but you're still able to raise 600 million against the company you plan to buy. And you're doing it because you have a track record. You've done this before. People are willing to buy your bonds because they think you can pull it off. So let's see where we are. Some hostile acquirer, let's give that person a name, T. Boone Pickens, Carl Icahn, has noticed that you have excess debt capacity. They've borrowed money using your assets as backing. Now they use that to fund the acquisition. You made their life easier. And right after they've done the acquisition, to add final insult to injury, here's what they do. They're a conservative CEO, right? As Jonathan pointed, in addition to not borrowing money, what do conservative companies do? They accumulate cash. Let's say we accumulated 300 million cash. Right after I buy your company using 600 million that I borrowed using your assets, you know what I do right after the acquisition? I take your cash to pay off the debt that I borrowed. It can't get any sweeter for me. When you're an underlevered company, that's the first thing you have to worry about. Am I the potential target of a hostile acquisition? You're saying, well, how am I going to make the judgment for my company? Let me throw a few companies and you tell me whether they're potential targets or not and why not. Let's say Microsoft is underlevered, and I think it is. Is it the potential target of a hostile acquisition? What's going to stop you? When you try to do a hostile acquisition of Microsoft, tell me a couple of things that are going to get in the way. Wanish, what's the first thing that's going to get in the way?
Maybe just the value of the firm. It might be too much.
It's a $2 trillion. That's kind of a tough call, right? Even the biggest activist investor raising 1.6 trillion, that's not going to be easy. So first is you're going to look at the size of your firm. If you're looking at a large company that's underlevered, there's really no urgency. An Apple, a Microsoft, a Facebook is not going to get targeted in a hostile acquisition. With Facebook, what's the second thing that's going to get in the way of my trying to do a hostile acquisition? Go back to corporate governance. Dan, what will get in my way when I try to do a hostile acquisition of Facebook?
Mark Zuckerberg?
Mark Zuckerberg, because he owns 55% of the voting shares. I might as well give up now, right? So I'm going to look at the insider ownership as a founder CEO, because if you have lots of insider ownership and a founder runs a company, that's good. And there's a third thing you're going to look at, which is you got to go buy the company at today's market price, right? If a company has done really, and in every hostile acquisition this happens, there's a fight between when you look at the choices you face as a shareholder, it's a fight between the incumbent managers of the company telling you not to sell your shares, and the hostile acquirer saying, don't trust the managers, sell me your shares. And you as a shareholder get to decide who to trust. So let me tip the scales. Let's suppose you are a shareholder in a company who's seen your stock price drop 80% in the last 5 years. Who are you going to trust? The hostile acquirer who says the managers don't care about you. The managers who say don't trust the hostile acquirer. Stock price is down 80%. You're saying, why should I trust you to the incumbent manager? You're far more likely to sell. So here's the bottom line. If you're a company that has done well in the recent past, you're far less likely to be targeted in a hostile acquisition than if you're a company that's done badly. By now in this class, you already have a measure of that, right? Remember that Jensen's alpha you computed for your stock? Assuming if that Jensen's alpha was a big negative number, what does it tell you? Your stock did not do as well as it should have after adjusting for risk. So let's set up the trifecta for a company that is going to be in real danger. First, it's got to be small or mid-sized. And I'll let you make the judgment on what that cutoff is. It's much higher than it used to be. 30 years ago, if you were more than $10 billion, you were too big. Today, you've got to be at least 100 billion. So small or mid-cap. Second, very little insider holding, no founder CEOs, because that makes it easier for me. And third, a big negative Jensen's alpha. Small companies, very little insider holding, negative Jensen's alpha, you are going to be a prime target. Don't wait for the Wall Street Journal, headline saying you've been targeted. You've got to do something really quickly. What's that thing got to be? You got to get rid of this underlevered. You got to go to your optimal debt ratio, in a sense, overnight. You say, how the heck do I do it? If I'm at 0% debt, how am I going to get to 40% debt by tomorrow? You got to do a recapitalization. What does it mean? You borrow money and buy back stock essentially overnight. You've gone from having no debt to 40% debt. You borrow money and pay a special dividend overnight, you increase your debt ratio. Why are you doing it? Because you need to get to that optimum quickly. That's if you're underlevered. And in a potential target. But let's say you are a big company, or you have insider holdings, or you have two classes of shares. Remember, all the things you did in corporate governance are going to play out here. You don't worry about being taken over. You have time as your ally. And my advice when a company has time as its ally is don't move abruptly to your optimal, because if you screwed up, then you got to move back quickly. Do it gradually. In other words, to get from 0 to 40%, take 4 or 5 years to go from 0 to 10, 10 to 20. And each point you can stop and ask, was this the right choice for me? And there, I'm going to give you choices, because time is now your ally. I'm going to ask you, do you have good projects? And again, remember I asked you to look at your return on capital versus cost of capital. We made a judgment on what do your existing investments look like. You say, why do you care whether I have good projects? Because if you have good projects and excess debt capacity, you have a marriage made in heaven. You can go out and borrow the money, and rather than buy back stock or pay a dividend, you should take good projects. You get a double whammy. The first whammy comes from moving towards your optimal debt ratio, lower cost of capital. The second whammy comes from taking good projects. Because what's the essence of a good project when you did capital budgeting? It has a positive net present value, right? And when you take a project with a positive net present value, guess what you get? You get the additional increase in value. So if you're a company with excess debt capacity, not in danger of being taken over quickly, and you have good projects, my advice to you is go take good projects with the debt. It's the best possible option for you. But if your projects don't look good, you're earning less than your cost of capital, you're in a bad business, then I'm going to ask you, what do your shareholders like? Do they prefer dividends or do they prefer buybacks? You say, how would I know? Your history gives you away, right? If you're Verizon, you have a history of paying big dividends, guess who buys your shares? People who like big dividends. If you're Google, you've never paid dividends, guess who buys your share? People who don't like. This isn't, again, magic or rocket science. You don't need to do surveys. There's a self-selection that goes on here. Because they like dividends, I'm going to ask you to pay more dividends. That gets rid of the cash flows and makes your equity go down. And if that's not the case, then buy back stock. So let's go through. For an underlevered firm, first stop you got to make is, am I in danger of being taken over? If the answer is no, then the next question becomes, do I have good projects? If you have good projects and excess debt capacity, you're not in danger. Take your time, take good projects, build up your debt ratio over time. If you don't have good projects and you're in danger, do something quickly. If not, do it gradually over time. It doesn't have to be all next year. It could be over the next 5 years. That's the underlevered side. Let's move to the other side of this picture. What if your firm has too much debt? As I said, pray and hope that this is not the case, because this is so much more unpleasant to deal with. Because the first question you got to ask is, how much time do I have? And here there's a morbid ring to the question, right? Because when you have too much debt, what's hanging over your head? Not that somebody will take you over, but that you could go bankrupt. I want to ask you, are you in danger? Saying, how would you know? If you run an actual business, do you know when you're in danger? You've stopped answering your phone, you stopped opening your mail, you're hiding from bill collectors, you've not paid your employees. Don't ask me, am I in danger? Of course you're in danger. If you're a company, your rating is double B, single B, triple C, don't even sit there and ponder this question. You are in danger. And if you're in danger, you have one final weapon left. And it's not something you're going to like. It's going to sound mildly unethical, maybe even immoral. What's the weapon you have left? You're in danger of going bankrupt. You try to get the best terms you can because you're saying, well, I'm going to try to bring the debt ratio down quickly. How the heck are you going to bring the debt ratio down quickly? If you're in danger and trouble, you can't issue equity. Nobody wants to buy your shares. You can't borrow money because who's going to lend you money? How do you pay off debt if you have lost access to capital, you're in danger? Here's what you do. You go to the people who've lent you money and you demand better terms. You say, why would they see to my demands? I mean, you know what you threaten to do if they don't agree to your terms? Where do you end up once you go bankrupt? And who gets all the money once you go bankrupt? You end up in the legal system and the lawyers will get all the money. So you say, look, you don't agree to my terms, I'm going to go bankrupt. It's amazing what terms people will agree to when they realize you're that close to the edge. I mean, it's like, you've lent money to somebody, you're trying to get him to pay you back. He's got a gun to his head and say, agree to my terms or I'll blow my brains out and you'll never see your money. You know what? You're going to agree to some terms you don't want to agree to because you have no choice. I'll give you my favorite example for the kinds of terms borrowers can extract from lenders. This was about 100+ years ago. Latin America was still the center of all sovereign defaults even then. So the late 1800s, I don't know which South American country it was, but they're probably interchangeable at that point in time. At that time, South American companies were borrowing money from European banks. Why were European banks lending? Because there was a lot of growth potential in South America. And this particular South American country got into trouble. It was unable to make its interest payments to a French bank. So send a message. Obviously, in those days, sending a message probably said putting somebody in a ship and sending them all the way to France saying, you know what, we can't make our interest payments on the loan you gave us. Would you accept some guano instead? You know what guano is? It's bird droppings. You're saying, why would anybody want bird droppings? They're very good fertilizer. Now, if you're a French bank and I offered to make my interest payments in bird droppings, no matter how good it is as fertilizer, what's your first reaction? I don't want your bird droppings. But then the South American country said, would you like that or would you like nothing? And the French bank thought about it for a moment and said, you know what, we'll take the bird droppings. Now, don't try this out on, if you run a company, on all of your lenders. They won't take bird droppings. But my point is, you're renegotiating for better terms because the threat of going bankruptcy is making your lenders more willing to accept those terms. So if you're in a hurry, it's not easy to bring your debt ratio down because every easy path has been cut off. You can't sell your assets because everybody knows you're bankrupt or in trouble. You can't try to issue equity because nobody wants to buy your shares. You've got to try to get the best terms you can. You're buying time. Of course, you could also have too much debt. MTN, for instance, has too much debt, but it's not going to go bankrupt. And if you don't have bankruptcy hanging over your head, I'm going to ask you the same question I asked you when you had too little debt. Do you have good projects? If you have good projects, my advice is fund those projects disproportionately with equity, even if it means issuing new shares, because over time, then your debt ratio will come down. It's the best way to actually get out of a debt problem is to grow your problem away. And if you don't have good projects, here's the first thing I'm going to ask you to do. If you're paying dividends, stop. Every time you pay dividends, it reduces your equity. And if you're already over-levered, what the heck are you doing still paying dividends? If you're buying back stock, no, don't even try that. Use your retained earnings to pay down your debt over time. Become a smaller, less levered company. It'll take a while, but you have time as your ally. So let me try this on Disney. Remember, I came up with an optimal of 40%. Its actual debt ratio is about 12%. Clearly, it's underlevered. Is it under threat of bankruptcy? Well, by the time I was looking at this in 2013, it was a $130 billion company, pretty big company. It didn't have a lot of insider holding, so that was a strike against it. But remember, the Jensen's alpha I computed for Disney was 9.02%, like, way back. So looking at those collection of facts, I concluded in 2013 that Disney was not the potential target of a takeover. You think that's pretty obvious, it's Disney. I've been looking at Disney since 97 in my applied corporate finance book. The first time I looked at 97, it was a $100 billion company, had done pretty well. I said, not a target of a takeover. 5 years later, in my second edition, I looked at Disney again. It had become a $50 billion company. Because what had happened, that ABC acquisition had blown up. Michael Eisner was perhaps the most hated CEO on the face of the earth. And your Jensen's alpha was this big negative number. What 2002, I concluded, if Disney is not careful, it could potentially be the target of a hostile acquisition. And if you remember, Comcast came through, right? A year later, Comcast announced this horrifically designed hostile acquisition. But when companies start to get worried? You know how you know? Because the CEO starts talking about how much he or she cares about shareholders. Think of this as a deadly sign. CEOs never care about shareholders until the threat of an impending execution kind of focuses their mind. I still remember the late 90s, a company called Telecom Italia, obviously the Italian telecom company, was targeted and acquired in a hostile acquisition. And it shocked European companies. Why? Because they thought this hostile acquisition phenomenon was purely Anglo-Saxon. Those barbarians in the UK and the US keep taking each other over. We don't do that in civilized Europe. So Telecom Italia gets taken over. Every European CEO starts to get nervous that this could happen to them. So they have a symposium, conference, whatever you want to call it, in, I think it was Geneva, some boring city. Now, I don't remember which Swiss city it was, but they're all boring, Zurich, Geneva. So CEOs of all these major European companies come together. And they asked me to be on a panel discussion. I absolutely hate panel discussions because you really can't say what's in your mind because everybody's everything is a debate. So I'm sitting next to the Siemens CEO. Siemens, of course, is a German company going back a century. And he gets back and he says, at Siemens, we care deeply about our shareholders. My reaction was the same one I had when I heard Madonna sing Like a Virgin, to which my reaction was, how would you know? I mean, Siemens is a company that treats its shareholders like mosquitoes, basically it's been a pest, and all of a sudden you care about shareholders? That tells me that there's fear here, and that's a good thing. So when you see your company start to get wary about a hostile acquisition, you don't have the luxury of sitting there devising 5-year plans. You got to do something quickly. Disney in 2013, I felt the time was on their side. I did also feel that they had good projects, and this was based on numbers, right? If you remember, I came up with the return on capital at Disney of, I think, 12.6%, if you remember. Their cost of capital was 7.6%. I don't want to extrapolate too much, but clearly they're picking good projects. You have debt capacity, you're taking good projects. And you have all these plans. At that time, streaming was not even on the horizon, but they're talking about building Shanghai Disney and expanding the movie business. I say, go out and borrow more than you normally would in funding these projects because you have excess debt capacity. What I want you to do with your company, if you have the optimal, is take it through this framework and think about what they should do next. For many of your companies, the answer is don't do anything right now. There's no rush here, but recognize you have debt capacity. So if you're Google, you have excess debt capacity. You know where they can use it if they decide to enter the electric car market. In the case, I made you stick with a 1.6%, which makes absolutely no sense. You have a $25 billion capital investment. They should use a lot more debt. Why? Because they have excess debt capacity, might as well use it. So look at your company. First make the judgment. Should I change the debt ratio quickly? Do I have time as my ally? Should I leave them as is? And then ask a follow-up question. Should I take projects or should I recapitalize? And that answer is going to depend first on how urgent your move has to be, and also what kind of projects you have. Bring together everything you have in your company, your Jensen's Alpha, your return on capital. This, as you go along, you see the project build on itself. What you've learned about the company is going to guide you on what they should do with that excess debt capacity. And as I said, if you want to change the debt ratio for your company quickly, there are two ways you can do it. One is you can, if you want to increase your debt ratio quickly, you can borrow money and buy back stock, pay a dividend, or you can issue new stock to invest in the big projects. But that's got to be really quickly done. So as Disney, that's tough to do it quickly, but if you can do it. If you want to decrease your debt ratio, then it's more difficult. You can sell your operating assets and try to pay down debt, or you can use equity. You can issue equity and use it to retire debt. So it's much more difficult to do quickly, but you can see that your choices will reflect what you want to do. And if you want to change debt ratios gradually over time, if you're looking at equity, dividends and stock buybacks become the mechanism for reducing equity over time. So if you increase the amount of dividends and stock buybacks you have, you're reducing equity over time. Debt repayments become the mechanism for reducing debt. So it's not, again, rocket science. You got to decide whether you have time as your ally, whether you want to do things quickly or gradually. And one final point about debt ratios, especially if you do it over time, is remember now that 40% optimal debt ratio computed is based on the firm value today. If you're going to do this gradually over time, that 40% may remain the same, but the value of your firm is expected to change over time. Your target dollar debt will be different if you're doing it over 5 years than right now. Do you see what I mean? If the value of your firm is $1 billion now, 40% is 400 million. That's easy. But I say, I'm going to target 40% 5 years from now, your value of the firm will increase over time because you've got a cost of capital and a cost of equity. The 40% then will be of the ending value, which might be 1.2 or 1.3 billion, a much bigger number. I know we're towards the end, but I'm going to at least get started on the last piece of that. So let's say you've gone through this process, you've decided that your company should borrow more money. The case of Disney, they're going to borrow money and take projects. And you ask me, what's the right kind of debt for my company? I kind of gave away the game on this one, right? In the very first class. I said, what does it depend on? It depends on what you're investing that money in. And I'll give you the very simple intuition as to why you want to match your debt up to your assets. I know the graph looks like a strange one, but basically let's assume that you have a company whose value goes up and down. It's a commodity company, the oil prices are high, the value goes up. So this wavy line is the value of the firm. And let's say this company borrows money and that debt remains the same no matter what happens to the firm. You know what's going to happen to this firm? Whenever the value of the firm drops below the debt, technically, this firm is bankrupt because the value of its assets is less than the debt. You think that's pretty obvious. What if I could, and you have to leave this to me because we'll talk about how you could do this. What if I could design debt that increases in value when your firm becomes more valuable and decreases in value when your firm becomes less valuable? In other words, very flexible debt. This firm actually has 25% more debt than the firm you saw in the previous graph, but it never goes bankrupt. You see why we tried to match debt up to assets? By doing so, we reduce default risk. What you're looking for is this ultimate cross-dressing security. It behaves like equity around you, right? It's flexible, but it behaves like debt when the tax guy comes in. So basically you get the best of both worlds. You get the tax advantages of debt and none of the downside of borrowing money because your debt moves with your assets. That's the dream you have in a company. And that's why when people say, what is the perfect debt for me? I'm going to turn the question back on them. Your company say, what's the perfect debt? I can't answer the question. So I want to ask you, well, how long-term are your projects? If you're Boeing, the answer is 50, 60, 70 years. If you're Dell, it might be 3 years. That tells me what debt should be, short-term or long-term debt. Then I'm going to ask you what currency your cash flows in. This isn't rocket science. You give me a pie chart and say 70% of my revenues are in dollars, 30% in euros. Your debt should be 70% dollar, 30% euro debt. And then I'm going to ask you, how does inflation affect you? Saying, what do you mean? Some companies have pricing power. You know what that means? When inflation is high, they can price things higher. When inflation is low, they can price things lower. Some companies don't. You're saying, why does that matter? One of the choices you have to make on debt is whether you want fixed rate debt or floating rate debt. Floating rate debt, the interest rates go up, but the interest rate in your debt goes up when overall interest rates go up, and it goes down. So interest rates move up and down over time. If you're a company with pricing power, you're a much better candidate for floating rate debt. Why? Because when interest rates are high and inflation is high, you can pass that cost through to your customers. If you have no pricing power, for God's sakes, don't issue floating rate debt. It'll squeeze you and kill you in the periods. So airlines, which have very little pricing power, should issue fixed rate debt. Brand name companies with about the same income should issue floating rate debt because they have pricing power. And if you're a high growth company, you face a challenge, right? If you borrow money, you don't want to be paying big interest payments right now because you need the cash flows for the company. Well, issue convertible debt. What does it give you? Convertible debt, the market price is much higher because you built in an option. So coupon payments are low right now when you're a high growth company, but as you grow, you're able to service the debt. 90% of debt design is very simple intuition. Next session, when we start, we're going to talk about special features you can add to your debt to make it even more sensitive to what you're doing as a company. But this is your starting point. Now, I'd strongly encourage you to think about your company and say, if I were designing debt for my company, what kind of debt would it look like? Okay, so let's stop there. We will continue with this discussion on Monday. See you soon.
Professor, can I ask a
Yes.
really quick question? Hi, it's Aaliyah. I might have missed this. I joined like 1 minute late, but are we still aiming for, I think it's the 28th for quiz 3, or are you going to push it because the last one got pushed?
No, I'll leave it at 28 because
Okay, cool.
because by the time we're done with Monday's session, that will be quiz 3. So there'll actually be enough time. So it'll cover only through what we do on Monday's session. So what happens
okay.
after the Monday session will not be on quiz 3.
Okay, great. Awesome. Yeah, because then we just get close to the end of the semester.
Yeah.
Thank you.
Professor, I don't think we have class coming Monday.
Oh, that's right. Next Wednesday then.
Yeah, just Wednesday.
Yeah, you're right. So Wednesday, Monday, and the following Wednesday. Okay. So next Wednesday, I'll see you next Wednesday. You're right. Thank you for reminding me of that.
Professor,
I'm not supposed to, one more thing, I'm not supposed to give you work this weekend, and explicitly I will not. But if you're way behind on your project, I'll let you decide what you want to do with this supposedly free weekend, because you want to enjoy the weekend, it's your choice, but then you will suffer for it in the following 2 weekends. So I will leave that choice to you, but I will not send you any emails between Friday and Sunday again, so you don't hear from me. So.
Professor, one question. So when we are talking about designing debt, are we designing it based on what corporate is lending, or are we designing on what we'll take in, what debt we'll take?
What do you mean corporate is lending? You mean what banks are offering?
No, sometimes corporates also lend so non-banking financial institutes. So,
but they're banks basically. So it's a lending institution of some sort. So when you say corporates, I'm not sure what you mean by corporate. So basically it's some kind of lending institution. Are you saying, are you constrained by what's out there? Absolutely. So what if you design your perfect debt and nobody will lend it to you? You're stuck with what you offered. Remember, this was one of the things we talked about in terms of what the advantage of having corporate bonds is, as opposed to being dependent on a bank or a lending institution. When you issue corporate bonds, you get a lot more freedom to build in things that you might not be able to build into a bank loan.
Oh, yeah.
So you live in the world you're in, which is the only thing you can get is a 10-year fixed rate loan. You can come up with all kinds of gymnastics. That my right kind of debt for me is a 30-year floating rate convertible bond, and you go into the bank and the bank says, no way, 10-year fixed rate bond. It's like buying a car in 1926 from Henry Ford. The Model T came in one color and one style. You want black? Good. If you don't want it black, still black. There's no multiple styles. So that's the problem with bank loans, is you're constrained by what banks offer. And the advantage is, even in parts of the world where corporate bonds were not accessible, they're starting to open up. It might not open up for everybody right away, but it's opening up. And when you have corporate bonds, you can design more flexible bonds.
And when corporates offer convertible bonds so that it can be issued for equity, is that also a part of designing this debt?
Yeah, if you're a high growth firm, that's why I said convertible debt is a much better choice for you than straight debt, because you keep your interest payments low right now and your cash flows are low. And as you grow and your cash flows go up, you let the convertible debt convert and become straight debt instead.
Thank you.
Cody and Henry, any questions for? No? Okay.
Thank you.
Take care. Bye-bye.
Professor, I was just laughing a few classes ago. You mentioned the preference for the types of capital.
Mhm.
So I used to work on the convertible debt and like preferred stock desk at Barclays.
Yeah.
And when I think about the clients that took up 90% of my time, I'd encourage you to look at the 10-year stock chart for Iconics, ticker Icon, and then Rate Financial, ticker RAS. It was
you are doing a service. You are taking care of the bedraggled, the homeless, the companies that could not raise capital elsewhere. So it's again, it's good to have those. Let me put it this way: in a world with just banks, you create far more cost because those companies would be the ones that tip over first, that go into distress. In a year like 2020, the reason we didn't see more failures was because we have so many more options to raise capital now than we did 20 or 40 years ago. And that's a good thing, because many of these companies are going to come back, but they need to make it through the toughest days. And I still remember when Boeing last April, when they were able to raise 12 billion in the private lending markets, that broke open the dam. Now, without it, I think we'd have been in serious trouble, much worse trouble. It actually triggered, I think, the kind of recovery you saw. So you were doing good. So pat yourself on the back, say, I allowed the economy to survive by offering preferred stock and convertible debt, because, and of course, when you go to really young companies, it's convertible preferred, right?
Yeah.
I mean, that's how VCs play. It's really all conversion option, but they don't want to call it warrants. They call it convertible preferred to kind of cover up the fact that the preferred there is kind of an afterthought.
Yeah, we pitched a lot of convert preferreds, but I don't think we ever actually did one.
Yeah, I think with start you get more with VCs and with startups than you do with seasoned companies.
Yeah. All right. Well, I figured you'd find that funny, but appreciate it. Thank you.
You're welcome. Take care.
Bye.
Professor, can you have time for one more question?
Sure.
So, okay, so I'm doing Shopify for my project. I've been doing everything in US, but looking back through, my company is founded in Toronto. It was first listed on the Toronto Stock Exchange. Now it's in the US, like Mexico, a bunch of other exchanges.
And when you say you did it all in US, you're saying you're doing it in US dollars? Is that what you're saying?
Yeah.
Okay.
Yeah.
That's fine. It doesn't matter where it's listed, right? Because
Okay.
you can do any company in any currency. So even if it's listed in the let's say the Bolsa, if you choose to do things in dollars, you can still do it. I can do Cemex entirely in US dollars, even though it's a Mexican incorporated and listed company. So don't worry about where it's incorporated. It doesn't matter. You can make your currency choice. Just stick with it. Stay consistent with it all the way through.
Okay. So I was looking back and I noticed they pay their executives in Canadian dollars. So I was wondering if I should. But obviously they get most of their money from.
It doesn't matter, right? Even if they got paid in euros, what difference does it make, right? Ultimately, financials, if they're all in dollars, everything gets converted to dollars, your income is in dollars, so I wouldn't worry about it.
All right, sounds good.
Yeah. Good. Okay, folks, I've got to run. I have my valuation class starting in 3 minutes, so